Hello everyone, so today I will be talking about how professional traders do the exact opposite of retail traders and what actually makes them successful in the markets. I will mention ascending and descending channels, liquidity zones, professional trade management, and I will mention a little bit about trader mindset, so how professional traders think in probabilities rather than having a win or loss mindset. So let's get right into the video and let me explain some of the concepts. So let's take a look at our first example. This is the euro and US dollar, which is currently in a heavy downtrend. You're seeing a large downtrend, nice momentum down. So what happens next? Well, we get a retrace candle. And at this point, most retail traders are thinking, okay, I'm going long. I'm going long right here. This looks to be reversing. I'm seeing this wick. I'm seeing this bullish candle. Let me place a buy order right now. And I will place my stop just below this wick where it is safe. So this is what the retail traders are thinking. And well, what happens? We get a slight profit and then we get this. So they actually get stopped out. We get a candle that breaks the low and retraces, leaves a wick. And this is actually what the market makers are doing. They know that most retail traders will keep their stops below this candle. So they push the price to grab that liquidity, which is located right here. So here is the liquidity, so that they then can move the price to the upside, so that they can then reverse the price. So the retail trader has now just been stopped out, and now comes the professional trader and is looking at this and is seeing that there has just been, let me delete this, there has just been a liquidity grab right here, and there is a high probability that the price will actually reverse to the upside. So let's see what happens next. At this point, the professional trader still sits on his hands because he is seeing momentum reverse to the upside, but he wants to see some more. So he wants to see some more confirmation. This is not enough. He wants to see, let's say, one more candle in order to get in on a long trade. So let's see what happens. Well, we do actually reverse to the upside. We get a nice momentum to the upside, 2 candles, nice close of this candle. And then the professional trader sees this. He sees that there has been a descending nature right here, descending structure. Liquidity has been taken, and the market makers are very likely to reverse the price to the upside. And we are now seeing that evidence that the market is likely to reverse. So the professional trader places his order, let's say at this most recent high, and has a, let's say, 12 pip stop loss. He gets tagged in by this wick, and then what happens? Well, the price reverses to the upside as expected. So this is actually how the professional traders think, opposite of the retail ones, because retail traders just see this reversal and they think, okay, this is going to reverse, let me place my stop right here. But there has been no liquidity grab, there has been no evidence either that we want to reverse, because look at these 3 impulse candles and look at these 2 impulse candles. So just if you compare this, look at these 2 candles, this is signaling a real reversal, or look at these 3, this is just too weak. So this is what the professional traders do. They look at where there has been a descending nature. So right here was this descending structure. As I said, liquidity grab, price retraced, broke the low, retraced, and then they saw the evidence that the market is likely to move to the upside. When looking at these 2 candles, they were enough evidence for the price to move to the upside. They placed their pending long order, got tagged in, and then grabbed some nice profits. So yeah, that's it for the first example. Let's now move on to the next one. So let's take a look at this example. Again, it's the euro and US dollar. Again, we are seeing a downtrend. We are seeing 3 large candles to a downside right here, and even above that we are seeing a downtrend. So large impulse pullback, another impulse pullback, another impulse. And what happens next? Well, we get a retrace. Right here, the retail traders see this. They think to themselves, okay, this is now reversing. I'm seeing a momentum shift. Let me place a buy order right now. They place a buy order, let's say they put their stops again below the low, because they think my stops are safe here, this is going to reverse or it's going to stop me out. but I'm seeing this momentum to the upside, and I think that this move is exhausted. So what happens next? Well, the price takes them out and retraces. They again take a loss right here, so they take a loss on this trade. Let me now remove this. Why? Because they put their stops in the most obvious spot, which is right below this low. And even if they did see this as a reversal, they should have waited for more evidence, for more of an impulse to the upside. This is just not enough. This just looks like a small pullback. So now they have been taken out. This liquidity area has been taken out. The market makers know that retail traders keep their stops at this level, so they have taken them out and retraced. The professional traders are still at this point sitting on their hands. They're waiting to see some evidence for what will happen next. So what happens? Well, the price starts to range a bit. We get this range. And now what we know, that when we see a range, so what the professional traders are thinking, there are liquidity areas below and above. And by liquidity areas, I mean that on the lower time frames right here, so the people that are going long place their stops in this area. The people that are going short place their stops in this area. They're trading the range, so they're going short here, buying here, short here, buying here. They're playing the range on the lower time frames and keeping their stops in these areas. So this is what the professional traders know, and that they know, and they know when they see a push into the liquidity area that it is very likely to just retrace. So what actually happens next? Let's see. Well, we get this candle right here. This goes into the lower liquidity area, and now the retail traders think, okay, this is now continuing with the larger downtrend. They're seeing this larger downtrend. They're seeing this impulse to the downside. And what do? Well, they place a short order right here, and they put their stops, let's say, above this high. They are now in a short trade. They are saying to themselves, okay, this is trending down. We had a small range, but we have continued to trend down, and they are short. And what happens next? We get more of a move to the downside, and then we push back to the upside. So they are again taken out for a 1% loss. The retail traders have now taken 2 losses, and the professional traders are still sitting on their hands. So actually what happened? Well, exactly the thing that I was talking about happened. There was a liquidity area right here. Because of the people going long, they placed their stops at this point, as I said, on the lower time frames. The traders that are playing the range on the lower time frames keep their stops here. Price pushed into the liquidity area and retraced back into the range. So now the professional traders are seeing this. They're seeing that the liquidity has first been grabbed here, and now again the liquidity has been grabbed right here. So retail traders have been taken out here. Traders on the lower time frames have been taken out with this move, and they're also seeing this nice momentum to the upside. 2 candle impulse, clean close. They're seeing momentum to the upside, and they are seeing that the market makers are very likely to push the price to the upside. So the professional traders then place their pending order, let's say with a 12 pip stop at the most recent high, which is right here, and they're ready to play this trade to the upside. They are ready to play a reversal trade, because they're betting on that this descending structure will reverse to the upside because of these liquidity areas which have been taken out. They then get tagged in, and the price reverses to the upside. So they are now in a major win. They are now taking a lot of percentage, and this is the exact procedure that the professional traders take, and the exact way that they think. So to recap, the retail traders have been taken out for 2 losses. One was going long right here, then they went short on this candle. But the professional traders were just seeing this, and they were searching for where the liquidity will be taken out, which, as we know, happened right here when we broke the low retrace, and also right here when we broke into the lower liquidity area, retraced, and then they were seeing if we can get some evidence to the upside. After these two candles, this was enough evidence for professional traders to be looking for a long trade, and then they placed a pending order, as I said, and the price reversed to the upside. So this is a very common pattern where we get a trend to a downside, then we get a range, then price takes out the lower liquidity area and we reverse to the upside. Very common pattern, and the professional traders know that this occurs and is high probability, and when they see this sort of pattern, they are very likely to place a buy order at this point. So yeah, that is it for this move. Let's move to the next one. Okay, so here we have another one. This is Euro and the Japanese yen, and what I'm seeing now, I'm seeing a trend to the downside. And what the retail trader is thinking, he's also seeing a trend to a downside, and he wants to enter in on a short trade. He wants to sell. So maybe he's looking for a small pullback to sell. So he's seeing momentum continue. He's looking for a small pullback. And then he's looking after the pullback for the momentum to still continue, to confirm to him that the trend is going down. So he's still waiting, not placing an order yet. But right here, maybe the retail trader likes this candle and he places a short order at this point, places his stop loss maybe above this most recent high, and he's very happy to go short right here because he's seeing this large trend to a downside. He's seeing a small pullback and he's seeing the momentum continue. But what happens next? Well, there is actually a reversal and he gets stopped out for a loss. The professional trader is just sitting on his hands at this point. He has not taken any trades. He is waiting for the market to show him some evidence, and right here he is actually seeing evidence that the market wants to reverse and that this downtrend is actually exhausted. So how did he know that? Because he was seeing a descending structure. He was seeing that the market couldn't break to a downside because it broke the low, retraced, broke the low, retraced, broke the low, retraced, left a wick in each case, and he knows that the liquidity has been grabbed. As I said, retail traders are going long at this point. They are also going long at this point. So here they get stopped out and they get stopped out again. So the retail traders have been stopped out twice now, and the market makers are very likely to reverse the price because they have grabbed the liquidity. And our retail trader that went long at this point was not paying attention to what was happening in the prior price action. He was just looking at the larger picture. He was seeing this huge trend down and he just wanted to get in the market and to go short, but he didn't notice this small descending structure, this move that is being exhausted, which you can clearly see. So he left the wick, broke the low, left the wick, broke the low, left the wick, which is clearly signaling to the professional trader that this move is exhausted. But the retail trader doesn't care about this. He just sees the downtrend and he pays the price for it because he gets stopped out, as we said. And now the professional trader is liking this. He is seeing the liquidity that has been taken twice right here. He's seeing that this large downtrend has come to an end, and the also very important part, he's seeing the evidence that the price wants to reverse, which is these three impulses. So at this point he is still waiting for the evidence, but when we get these three large bullish candles, he is very happy to place a pending long order for the price to reverse at, let's say, the most recent high with a 12 pip stop loss. And what happens next? Let's see. So the price starts to range a bit. He gets tagged in. I think he would get tagged in because I know I would get tagged in because I would place the pending order 2 pips above the most recent high. So, and then, well, the price actually reverses to the upside. And exactly what was forecasted actually happened. The professional trader was expecting this and was seeing evidence that will happen. before, so he was happy to place that risk when he saw evidence that the price wants to reverse. So this is another clear example how the retail trader doesn't look at what happens in the price action bar by bar. He just looks at the larger picture. He doesn't pay attention to descending and ascending structures. And what the descending and the ascending structure tell us, they tell us that the market can no longer move down or up. It is exhausted and it is most likely to reverse. Also, liquidity is being taken. We can also see that, which is always a good sign. Just a second. Which is always a good sign that the market makers have taken out enough liquidity and that they then want to reverse the price. So this is a clear difference behind the thinking of a retail and the professional trader, where the retail trader looks for shorts right here, and the professional trader knows that this is very likely to actually reverse to the upside. So that's it for this example. Let's now move on. Okay, so here we have the Aussie and the US dollar, and this example is a clear example of where liquidity areas are located and how the price reacts in those liquidity areas. So when I say liquidity areas, I mean that there is a range and that there are liquidity areas below and above this range. Why? Well, because the traders on the lower time frames are selling right here and they keep their stops above, and the buyers are buying right here because they're betting on that the price will go to the top of the range, and they're placing their stop losses below that area. So that is the mechanics behind liquidity areas. And now let's first see what the retail trader is thinking. So maybe the retail trader is seeing this as a reversal from this descending structure, and he's seeing this simply as a small pause, a small pullback before we continue to the upside. So then he waits to see if we will continue. He sees this candle and he says that this is a great candle. We are going to continue with this reversal. This will be a large uptrend. I will place a buy order right now because this is also a clean close. There is no wick, and he places a buy order at this point. Let's say his stop loss is right here, and he's happy with this trade because he's seeing a reversal, nice impulse, small pause, and a continuation of the momentum. So what happens next? Price ranges for a bit and he gets stopped out again for a loss. So at this point, what was the retail trader thinking wrong? Well, let me delete this. He wasn't seeing that this was actually a range and that there were liquidity areas above and below this range. Because as I said, on the lower time frames, the traders are buying right here, betting that the price will reach the top of the range, and they're selling right here, betting that the price will reach the bottom of the range. Where they keep their stops? Well, the sellers keep their stops in this area and the buyers keep their stops in this area. And what happened? Well, the price went into the upper liquidity area and retraced. Meaning that now the liquidity has been grabbed from all the stop losses from the lower time frames, and that the market is very likely to reverse to a downside. And now let's go over how the professional trader thinks. Well, he sees this breakout of the range, but he wants to see more evidence. He wants to see a continuation because he knows that this can easily just retrace back and continue ranging. So what happens? There is an immediate retrace, and the professional trader is then sitting on his hands waiting to see what will happen next. He then sees some volatility, he sees a large wick, and then he sees that the price just goes back into the range and starts to range again. So he stopped himself from making a loss trade right here, which the retail trader took, because he knew that there are liquidity areas above. So as I said, right here was a clear liquidity area from the prior range. and he knows that if we get just one candle into the liquidity area, it can easily just retrace back and continue ranging. So then the professional trader sees this, and he knows that the liquidity has now been taken out and that the market makers are very likely to reverse the price to a downside. So let me take it back to this point. The professional trader now knows that there is a very high probability price will reverse to a downside, but he's still sitting on his hands. He's looking for some evidence and some momentum to the downside in order to look for, let's say, a short trade. So what happens next? Well, he waits a bit more. There is a one candle down, and there is now a second candle to a downside. Clean close, almost no wick, so a very good sign. And he's now happy to place a pending short order, let's say, so at this level right here, which would be an inside bar and a 12 pip stop loss. And he's now happy to take this short. Why? Well, because as I said, the liquidity has been taken out right here, and the market is likely to reverse to a downside. And also this does look like an ascending structure. And what happens after an ascending structure? Well, we usually get a reversal to the downside. So let's see what happens next. He gets tagged in his short trade, and the market reverses to the downside. So he was again right in his prediction. This was a high probability setup, so that means there was a higher chance of it going down than up, and he knows that that this will give him a positive expectancy in the long run. So he takes a profit, and the retail trader again takes a loss because he didn't pay attention to the liquidity areas. He didn't pay attention to how the market actually works and what the market makers are doing, which is taking out liquidity, taking out people's stops. So this is another clear example how the liquidity areas operate in the market and how liquidity is taken out, and how the price usually reverses after an ascending structure, which I just showed. So we got this ascending structure and the price reversed. So yeah, that is it for this example, and now let's move on to the next one. Okay, so for this part of the video I will talk a little bit about trade management and why it's really important to have a fixed trade management instead of doing it by discretion and by feel. So let's now say that the retail trader has taken that 1% loss right here, but he has gotten a little bit smarter. He learned some things about the market and is now seeing this descending structure, and he knows that it is very likely that the price will reverse to the upside and keep trending to the upside. So what does he do? Well, he sees this impulse to the upside, he sees this reversal. In the prior price action, he sees that the liquidity has been taken out and that the market makers are very likely to start a trend to the upside. So he places his pending long order at the inside bar, which would be this one right here, with, let's say, a 12 pip stop loss. And this is the exact type of thinking that the professional trader would also take. So he would be seeing this descending structure. He would be seeing that the liquidity has been taken out right here. There was a small range. There were stops in this area that got taken out. And he was seeing an evidence of a reversal by looking at this impulse right here. And he placed a pending long order at this level. So now both the retail trader and the professional trader have a pending order at the same level and are looking at the same thing in the market. So let's see what happens next. Well, both of them then get tagged into the trade. And now comes the very important part of how the retail trader will manage this trade. Well, probably because he took a 1% loss right here, as we were saying, he thinks to himself, okay, I will either target a break even on this one, because I want to be at least break even for the end of the week, let's say, or I want to target a 2-to-1 so that I will be net profit 1% because he took a 1% loss here, and then this would be a 2% win, so net profit would be 1%. So let's say he's feeling lucky and he says, I will target a 2-to-1 risk to reward. He places his take profit at a 2-to-1 level. So his stop loss was 12 pips, his take profit is 224 pips, and he waits. Price reaches his take profit level and he takes a 2% gain on this trade. So that is very nice, but it's not really the right approach that the professional trader takes. Now let's see how the professional trader thinks. Well, the professional trader thinks, okay, I have a fixed trade management for every single trade. I don't deviate from it. I don't go by feel. Instead, I manage every trade in the exact same way. And he does that by, let's say, moving his stop loss underneath the most recent low in this case. So what he waits for, he waits to see price move to the upside. And then he waits for the first counter trend move. Then he still hasn't moved his stop loss. But now he waits for the break of the high. Price has now broken the high. And then he moves his stop loss underneath the most recent low because that's his fixed management style. That is the way he manages his trades. And he now waits to see what will happen. Price breaks the high again. He moves his stop underneath the most recent low, which is here, one more time. And then he gets taken out for 4.7%. So the professional trader has taken a 4.7% win, while the retail trader has maybe taken a 2% win or even less because he was feeling down because of the prior 1% loss. So why did the professional trader place his stop underneath this level? Because he knows that when the market starts to ascend, it is likely that the market will reverse. And the exact thing happened here. So the market had an impulse and then it started to ascend, signaling the end of the up move and that the market is likely to reverse. So that is why it is really important to have a fixed trade management, to remove discretion and to remove emotion, because emotion makes us take profit too early or revenge trade or move our stop loss where we don't need to move our stop loss. And by having a fixed trade management, it removes discretion and emotion, makes everything much more simple, and in the end, at the end of the year, makes the profits much bigger because we let the profits run and we make the losses really small. So yeah, that's it, and now let's move on. Okay, so let's now take another example why having a fixed trade management is really important. Let's say that the retail trader and the professional trader are looking at the market in the same way and that they are seeing this descending structure right here. They're seeing momentum reverse to the upside. They're seeing a nice large impulse to the upside, and they are very happy to place a pending long order at this inside bar because they know that the price can just tag them in and shoot to the upside. So let's say they both now have a pending long order right here at this level, 2 pips above. That's how I do it. And then what happens? Well, they get tagged in. And now both the retail trader and the professional trader are in the same long trade and are looking for the market to move to the upside. Let's now see how the retail trader will handle this situation and how the retail trader will take profit. So what the retail trader is waiting, he's waiting for a little bit of a move to the upside so that he can immediately move his stop to break even. Why? Because he is afraid of taking a full 1% loss. He wants to reduce his risk as soon as possible, and he doesn't have a fixed trade management. So his emotions start to kick in, which say to him, take a break even as soon as you can, move your stops to break even. What happens? We get a bullish candle. He sees this. His emotions start to play in and his mind tells to him, move your stops to break even. This is going to shoot to the upside or it's going to take you out. Those are the two possibilities. Better reduce your risk as much as possible so that you don't take that loss. He removes his risk. He is now break even. And what happens? Well, he gets taken out for a break even and has now taken a break even trade. So he is currently happy because he has avoided a 1% loss, or at least he thinks that way. And now let's see how the professional trader thinks. So the professional trader is also taken in by this candle. He also has a 12 pip stop loss, but his fixed trade management says that he will only move his stop loss once the price breaks the most recent high. Well, let's see what happens. He currently still has a full risk on the table, full 1% risk. And well, what happens then? The price breaks the most recent high, gives a counter trend move, breaks the high again. He can now put his stop loss underneath the most recent low and lock in some profit. Let's see what happens. Again, he would lock in more profit because the price continues trending. Another counter trend move, he moves his stop to here. Then another counter trend move, break of the high, he moves his stop to here. This is how his trade management works, and he follows it 100%. And he currently has locked in 7% profit. And then what happens? Well, he gets taken out. He gets taken out for a 7% profit. And the retail trader is now very, very angry that he took only a break even because he's seeing the price shoot to the upside. This happens all the time, where the price just goes in profit and then takes you out for a break even. So it is very important again to have a fixed trade management where it will remove emotions, remove discretion, and you will not be in these cases where you put your stops to break even too early and then you see the market shoot to the upside. So that is it for this part, and now let's move on to the final part. Okay, so for the last part of the video, I will talk a little bit about thinking in probabilities and having a professional trader mindset. So let's see how the retail trader thinks. Well, the retail trader really cares about win rate. He often gets emotional when he loses. He tends to revenge trade. He takes his profits too soon. He lets his losses run. And his strategy has a 70% win rate. He loses usually 1%. He wins 1%. He has a fixed take profit and a fixed stop loss. So he doesn't let his profits run, which is a very, very bad thing, of course. And 100 trades give him around 40% profit. So when he takes 100 trades, at the end he will usually have a 40% profit, which usually is even less because his emotions tend to wreak havoc, because he doesn't want to lose, he doesn't like to lose, and he gets very emotional when he takes a loss, so he tends to make a lot of mistakes. And now let's see how the professional trader thinks. Well, the professional doesn't care about win rate. He only cares about letting his profits run and cutting his losses short. He only cares about putting himself in the best position in the market and taking high probability trades that will give him a lot of percentage, but when they lose very, very small. So his strategy has a 40% win rate. He loses maximum of 1%, but when he wins 5% on average. So that can be 7%, sometimes 3%, sometimes 15%, sometimes only 1%, but it's never a fixed take profit. He has a fixed trade management, which moves his take profit as the market moves. That means that 100 trades give him 140% profit. So this is much bigger than the retail trader, and also he tends to make a lot less mistakes because he knows that the losses are part of the game and that the win rate doesn't matter at all. He only cares about letting his profits run and putting himself in the best position in the market. So as you can see, at the end, this is 40%, this is 140%. So the professional trader is thinking in probabilities and he doesn't care about losses. He knows that they're a part of the game. So yeah, that's it for the video. Thank you guys for watching. I hope you enjoyed it and I hope you take some value out of it, and I will see you in the next one.